Debt and credit are two terms that are often used interchangeably, but they have different meanings. Debt refers to money owed to a person or an organization, while credit refers to the ability to borrow money or the amount of money that is available for borrowing. Debt and credit are both important financial tools that are used by individuals and organizations to manage their finances. However, if not used wisely, they can lead to financial problems. We will explore the concepts of debt and credit, their advantages and disadvantages, and how to manage them effectively. Understanding debt. Debt is an obligation to pay back money that has been borrowed. It can be incurred for various reasons, including to finance a business, purchase a home or car, or pay for education. Debt can be classified into two categories: secured and unsecured debt. Secured debt is debt that is backed by collateral, such as a house, car, or other assets. The collateral serves as security for the loan and can be seized by the lender if the borrower fails to repay the loan. Examples of secured debt include mortgages, car loans, and home equity loans. Unsecured debt is debt that is not backed by collateral. Examples of unsecured debt include credit card debt, personal loans, and medical bills. Since there is no collateral, unsecured debt typically carries a higher interest rate than secured debt. Advantages of debt: provides access to capital. Debt can provide access to capital that can be used for business or personal expenses. Builds credit history. Paying off debt on time can help build a good credit history, which can be beneficial when applying for loans in the future. Can be tax deductible. Some types of debt, such as mortgage interest, can be tax deductible. Disadvantages of debt: high interest rates. Unsecured debt, in particular, can have very high interest rates, which can make it difficult to pay off. Risk of default. If a borrower is unable to repay the loan, the lender can seize the collateral, if it is a secured loan, or take legal action to recover the money. Can lead to financial problems. If the debt is not managed properly, it can lead to financial problems, including bankruptcy. Chapter 2. Understanding credit. Credit is the ability to borrow money or the amount of money that is available for borrowing. Credit can be obtained from various sources, including banks, credit unions, and credit cards. Credit can be classified into two categories: revolving credit and installment credit. Revolving credit is a type of credit that allows the borrower to borrow up to a certain limit and then repay the debt as it is used. Credit cards are a common example of revolving credit. Installment credit is a type of credit that requires the borrower to repay the debt in fixed installments over a period of time. Examples of installment credit include mortgages and car loans. Advantages of credit: provides flexibility. Credit can provide flexibility in managing finances and making purchases. Builds credit history. Like debt, using credit responsibly can help build a good credit history. Can provide rewards. Some credit cards offer rewards, such as cashback or travel points, for using the card. Disadvantages of credit: high interest rates. Credit cards in particular can have very high interest rates, which can make it difficult to pay off the debt. Risk of overspending. Credit can lead to overspending, which can make it difficult to repay the debt. Can lead to financial problems. If credit is not managed properly, it can lead to financial problems, including bankruptcy. Managing debt and credit. Managing debt and credit is essential for maintaining a healthy financial life. Here are some tips for managing debt and credit effectively. Create a budget. A budget is a plan that outlines your income and expenses. By creating a budget, you can identify areas where you can cut back on expenses and use the savings to pay off debt or save for the future. Make sure to include all sources of income and expenses, including debt payments, in your budget. Prioritize debt repayment. If you have multiple debts, prioritize which ones to pay off first. Start by paying off debts with the highest interest rates, as these will cost you the most in the long run. Make sure to make the minimum payments on all debts and use any extra money to pay off the debt with the highest interest rate. Avoid new debt. While it may be tempting to take on new debt, try to avoid it as much as possible. Only take on debt for essential purchases and make sure you have the plan to pay it off.